Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're embarking on a deep dive, really cutting through the noise from Bloomberg, MarketWatch, The Wall Street Journal, and Barron's. Our mission: to quickly arm you with the most critical financial intelligence. Transform that stack of articles into concise, actionable insights. We're going to cover everything from big tech's, gargantuan AI ambitions and what the Fed might do next, to shifting global trade dynamics and some, frankly, surprising market opportunities. We'll pull out those essential nuggets, give you a shortcut to being truly well-informed about what's actually moving markets today.
So let's jump right in, starting with the colossal world of the AI arena. Okay, so NVIDIA's latest earnings. Definitely a mixed bag, wouldn't you say?
Yeah, I mean, they beat overall expectations for the quarter, which is, good.
Right.
But that revenue forecast for Q3, around $54 billion. Both Bloomberg and MarketWatch called it tepid.
Tepid, yeah. That seems to be the word. Exactly. And that perceived deceleration, after this massive 2-year AI boom, well, it sent shares down in pre-market. But what's really fascinating here, I think, isn't just that immediate reaction. It's how it clashes with the sheer scale of expected AI spending.
You mean the CapEx?
Precisely. Wall Street already has Amazon, Meta, Alphabet, Microsoft. They're expected to spend over $400 billion next year on AI infrastructure.
$400 billion just next year.
And get this, Roth analysts are now saying even that estimate is, quote, conservative for 2026.
Wow. So that raises a huge question then, doesn't it?
It really does. It presents this fundamental tension.
Yeah.
Are we on the cusp of like an unprecedented productivity boom? Or, as some analysts are kind of whispering, are we building this infrastructure overhang, where compute supply might actually outpace the immediate monetizable demand?
That's the multi-trillion-dollar question right there.
Absolutely. That's the core debate.
Because, despite those slowdown concerns, NVIDIA's CEO Jensen Huang, he is not backing down.
Not at all.
He flatly rejected the idea of flagging interest. He's projecting, $3 trillion to $4 trillion in AI infrastructure spend by the end of the decade.
Astonishing numbers. And to underline that confidence, the board approved another $60 billion in stock buybacks.
Okay, so how do we reconcile that, that huge long-term vision with the market's more cautious reaction right now?
Well, it's that classic divergence, isn't it, between the visionary's decade-long outlook and the market's laser focus on the next 2 quarters.
Right.
So while Huang paints this grand picture, Bloomberg's deeper dive did show that NVIDIA's data center unit, it actually slightly missed the average estimates. Still immense, but a slight miss.
Okay, so what does that hint at?
It hints that maybe some of those really big data center operators might be, tightening at the margins, as they put it, especially if those near-term AI returns are proving a bit harder to quantify on their balance sheets right now.
So it's not a lack of belief in AI's future, just maybe the timing of the payoff?
Exactly. It seems more about reevaluating the pace of its current commercialization, perhaps.
Okay, let's pivot slightly within this AI world. The China challenge for NVIDIA, it seems increasingly complex. Their Q3 forecast, for instance, it excluded H20 AI chip sales to China. That's a drop of about $4 billion from before.
Yeah, that's significant.
And the U.S. government's proposal to take a 15% slice of revenue from those sales. NVIDIA's worried, right, about potential lawsuits, competitive harm, if it's not properly codified.
It's a really tricky spot. And this brings us right into that narrative of strategic competition.
How so?
Well, what this really tells us is the global tech landscape. It's not just about market dynamics anymore. It's become this explicit strategic battleground. National interests are fundamentally reshaping company valuations, global supply chains, everything.
Yeah, you can see it.
It pushes companies like NVIDIA into these really uncomfortable choices between, growth and geopolitical compliance. And at the same time, we're seeing this interesting upstart rival emerge in China, Cambricon Technologies.
Oh, yeah. MarketWatch reported that huge revenue surge.
Massive surge.
Okay.
A staggering 4,000% growth.
4,000%. That's an eye-popping number. But we need perspective here, right?
Absolutely. Definitely keep perspective. While it's impressive on paper, Cambricon is still, a rounding error globally compared to NVIDIA's scale.
Okay.
But that aggressive growth, especially within a protected domestic market, it really underscores the accelerating pace of the U.S.-China chip battle.
So it suggests China's really pushing for alternatives.
Exactly. Pouring resources into developing their own stuff, even if it's not globally competitive yet. The goal isn't just market share, it's tech self-sufficiency.
Okay, but on a more positive note for the whole AI story, let's look at the software side. Snowflake Inc.
Yes, Snowflake.
According to MarketWatch, they wowed investors this week, solidly beat Q2 earnings expectations.
They did. Reported $1.1 billion in revenue, which is a robust, 32% year-over-year increase?
Yeah, right. And that really solidifies their reputation as a leading AI beta platform. They even raised their full-year revenue outlook.
And Snowflake's success, I think, really highlights something critical.
Which is?
That the AI boom isn't just about the hardware, the chips powering it all. It's equally, maybe even more, about the platforms and services that let businesses actually use that AI, manage their data, build applications.
Gotcha. The enablement layer.
Precisely. Their strong performance shows the diverse opportunities across the whole AI ecosystem, from the basic compute right up to the applications. So yeah, while hardware might see some tightening at the edges, the software and platform layer, it's showing really robust growth.
Yeah.
Demonstrates the ecosystem's diversity, the different ways to make money from it.
Okay, so while tech grapples with AI opportunities and these geopolitical pressures,
Yeah.
all this investment and innovation is influenced by the bigger monetary picture, right?
Absolutely. Fundamentally.
Which brings us to our next big focus, the Federal Reserve. What are they going to do next?
Right.
Wall Street seems increasingly convinced they'll cut rates.
Yeah, the betting is definitely leaning that way.
Yeah.
CME FedWatch data shows investors are now, 87% sure the Fed cuts in September.
Yeah, up from 82% just last week. That's a quick shift.
It is. And this growing conviction, it raises a really important question, especially with all the political crosscurrents swirling around.
You mean the pressure from President Trump?
Exactly. MarketWatch highlighted his ongoing push, specifically trying to remove Governor Lisa Cook. But the real insight here isn't just the politics itself. It's the deeper worry that this kind of sustained political interference, it could lead to, and this is the quote, emerging market-style risks for U.S. Treasuries and the dollar.
Wow, that sounds serious.
It is, because it threatens the perception of Fed independence, which is just foundational to global confidence in the U.S. economy.
And could spark future inflation if policy gets politicized.
Precisely. This isn't just a headline. It's a potential erosion of, institutional credibility.
And we're already seeing maybe some early warning signs. The 30-year Treasury yield briefly nudged towards 5%. And that steepening yield curve people talk about, that's often seen as a potential warning, isn't it?
It can be, yes. It often signals expectations of higher inflation down the road, or maybe future economic stress.
And MarketWatch also pointed out this concern that markets are, quote, running so low on extra cash, sparking debate about whether the Fed might need to actually bolster liquidity.
Indeed. So you've got these political dynamics plus the technical stuff like the yield curve and liquidity worries.
Yeah.
It adds significant layers of uncertainty to an already complex outlook.
Yeah.
So the Fed's next moves, they're being watched through this dual lens now. Economic data, we've got jobless claims and revised Q2 GDP today, and political pressure.
Makes their job even tougher.
Absolutely. They're navigating inflation, employment, and the perception of their own autonomy. It's critical.
Okay, let's shift focus across the Atlantic. Europe. Financial markets there are also feeling tremors of political uncertainty.
France, in particular.
Right. French Finance Minister Eric Lombard. He's trying to sound reassuring, dismissing talk of a crisis despite the likelihood of Prime Minister Bayrou's government collapsing next month over fiscal plans.
Yeah, Bloomberg reported Lombard is confident about hitting this year's 5.4% budget deficit target. He says they'll push ahead with the 2026 finance bill, too.
But the markets aren't entirely convinced.
Well, the insight here is that market confidence is often more fragile than official statements.
Yeah.
That political uncertainty around Bayrou's upcoming confidence vote, it has already, quote, rattled financial markets. Investors are betting on more fiscal problems.
How can you tell?
Look at the yield spread between French and German 10-year debt. It hit its highest level since January. It's a clear sign the market is pricing in increased risk, whatever the officials say.
So Europe's got its own fiscal tightrope walk. And then across the globe, there are even more complex situations, like Japan's bond market. Bloomberg called it a value trap for foreign investors.
Yeah, that's a great description. Take Brendan Murphy from Inside Investment. He saw this seemingly juicy 7% annual payout betting on 30-year Japanese government bonds.
Sounds good on paper.
Right. But the trade is, quote, proving a flop. Why? Because the Bank of Japan hasn't raised rates since January, and that grinding inflation just eats away at longer-dated debt returns.
So why isn't the BOJ raising rates?
Well, this isn't just a simple miscalculation by investors. It shows how deep structural factors can mess with conventional logic. The BOJ is really hesitant to raise rates further. They're worried about hurting a very fragile economic recovery.
Okay.
Plus, there's the prospect of more fiscal stimulus, meaning more debt, and even changing demographics play a role.
Demographics, how?
Japan's aging population means life insurers actually need fewer long-dated bonds to match their liabilities, so domestic demand is lower.
Fascinating.
Yeah, and the key insight is, even with foreign buying slowing down, some folks, like Murphy, are apparently holding on, hoping for a home run if the BOJ eventually does act.
A high-stakes bet, then.
A very high-stakes bet against some powerful, ingrained economic forces. Makes it a real trap for anyone expecting a quick, easy win.
Okay, now for a segment where things get really diverse, maybe a bit unexpected, small caps. The Russell 2000 index, it's been on a tear apparently, up 7.3% in August. Bloomberg notes that ties for its best month relative to the S&P 500 since, what, July 2024?
That's right. After years of underperforming, though it's still almost 3% below its all-time high from back in November 2021.
So what's driving this, and more importantly, can it last?
Well, part of the momentum seems fueled by hopes of looser monetary policy, Fed rate cuts.
Right, that usually helps smaller companies.
Yeah, it tends to benefit regional banks, industrial companies within the index.
Yeah.
They're often more sensitive to interest rates and the domestic economy. However, strategists like Lori Calvasina from RBC Capital Markets, they're cautioning that Fed cuts alone might not be enough.
Need something more.
Yeah, without a stronger economic backdrop overall, it might fizzle. And here's the really key insight, I think. The ultimate fate of these small caps. It likely rests on the fortunes of the largest U.S. technology stocks, the Magnificent Seven.
Ah, so even the small cap rally is tied to big tech.
It suggests it's not entirely independent, yeah. It's kind of tethered to the broader health and leadership of those tech giants. Makes it feel like a potentially fragile recovery.
So not a truly broad rally yet, and it seems traders are skeptical too. Options market positioning is described as very short.
Skepticism abounds.
But for those who do want to bet on some upside, maybe while protecting their downside, Wall Street pros are suggesting buying call spreads on the Russell 2000 ETF, IWM. Can you quickly explain what that is, a call spread?
Sure. Think of it like this.
Yeah.
It's a way to bet on a stock or ETF going up, but you put a cap on your potential profit and you limit your upfront cost.
Oh.
You buy one call option, which gives you the right to buy at a certain price, but you simultaneously sell another call option with a higher strike price. That sale offsets some of the cost of the first option, but it also limits your potential gains if the price shoots way up.
Gotcha. So it's good for moderate upside expectations.
Exactly. It's attractive when you expect some upside, but you want to limit your risk, limit your cost. For the Russell 2000, it's a way to, as Bloomberg put it, rent this tactical play.
Rent at the play. I like that.
Yeah. Lets you participate in a potential short-term rally without going all in, especially given that market skepticism and the whole Magnificent Seven dependence we just talked about.
And speaking of unexpected, this next one really caught my eye. Trump Media and Technology Group Corp. Partnering with Crypto.com.
Right. Interesting move.
They're creating a crypto treasury company. Now, this isn't just another company buying Bitcoin, is it? What does this signal? Especially using a lesser-known token like CRO.
Yeah, you've hit the nail on the head. This isn't just buy and hold. It feels like an evolution in how corporations might use crypto.
Okay.
The deal involves a mutual cooperation agreement. They plan to introduce a reward system on Trump media platforms Truth Social, Truth Plus, and they'll adopt CRO, the native token of the Kronos ecosystem, as a utility token, using Crypto.com's digital wallet.
So different from Michael Saylor just stacking Bitcoin.
Very different. The crucial distinction is focusing on CRO, a less mainstream token, and integrating it as a functional, incentivized part of the platform's user experience, not just a treasury asset.
Right, utility.
Exactly. It signals a potential move beyond just asset holding towards actual integration. And we are seeing a broader trend here. Japan's Metaplanet Inc. is also seeking, $880 million from overseas shares to fund Bitcoin purchases and options trading.
So more companies using public markets for crypto exposure?
Yes. It further legitimizes digital assets, both as investments and potentially as integrated tools.
Okay, from crypto to a perhaps more niche but pretty effective hedge fund strategy, convertible arbitrage.
Ah, yes, Convert Arb.
Bloomberg reported this has returned almost 6% through July, making it one of the top performers this year.
It's having a good run. Convertible arbitrage, basically, is where managers try to profit by buying a company's convertible bonds.
Those are the ones that can be exchanged for stock, right?
Correct. So they buy the convertible bond and simultaneously short sell the company's common stock. And right now, it's described by Man Group as a perfect environment for this trade.
Why perfect?
Because you've got relatively stable corporate credit quality, but combined with increased volatility in individual stocks. Think about crypto-linked firms like Michael Saylor's Strategy, Inc. That kind of volatility creates ideal conditions for this arbitrage.
And there's more supply of these bonds, too.
A flood of them. New convertible bond issuance is around $65 billion so far this year. That's already more than all of 2023. So it's expanding the opportunities for these managers significantly.
So the insight is,
while many folks focus on the big market trends, savvy players can find really substantial returns alpha in these market inefficiencies and complex instruments.
meanwhile, on the strategic M&A front, Warren Buffett's Berkshire Hathaway boosted its stake in those Japanese trading houses, Mitsubishi and Mitsui.
Yeah, MarketWatch noted that, doubling down on a long-standing bet on that sector.
And this links, maybe surprisingly, to something Barron's reported on.
Yeah.
The U.S. potentially getting an accidental sovereign wealth fund.
That's a fascinating angle. Tell me more.
Well, the Trump administration has taken stakes in Intel 9.9% MP Materials. They're set to get 15% of NVIDIA and AMD chip sales in China.
Right.
And there's even talk of potential stakes in defense firms like Lockheed Martin.
Wow. So the government is becoming a direct equity holder in strategic industries.
Exactly. And the profound insight here, I think, is that we're seeing this philosophical shift in government intervention. It's blurring the lines between national security, industrial policy, and economic strategy.
Yeah, it's not just regulation anymore. It's active participation.
Right. It's the government becoming an active equity-holding participant in the market.
So what's the debate around this? Officials must be saying it secures strategic resources.
That's the argument, yes. But experts, like finance professors Felcher Fotak and Bill Megginson, they're questioning the effectiveness, the transparency, and especially the risk of politicization.
Makes sense.
They draw comparisons to Norway and Singapore's successful, well-governed sovereign wealth funds versus what they call goofy projects by others, like Saudi Arabia's Public Investment Fund, perhaps.
Right. So the danger isn't just theoretical. It's about the practical risks of government-led investments. Without really strict governance, transparency, a clear, apolitical mandate, these things can easily become less about market efficiency and more about political favors or pet projects.
Yeah.
The lesson from successful sovereign wealth funds seems clear.